Hello and welcome back to HPD Trading's weekly fundamental overview. This is for the week starting the 10th of March 2025. And for this video, we're just going to go over the main points in the market from a fundamental and technical point of view for the upcoming week. As always, this is not financial advice. This is just how we here at HPD Trading see the market. So to kick things off, we're going to look at the general risk in the market. So the main indicator we have for general risk is the VIX index, which is essentially a measure of the volatility in the market. Now, as you can see, we've denoted a red line here at the 20 level, and anything above this level is considered a risky market environment and therefore safe havens, whether that's gold, whether that's silver, whether that's the US dollar, the yen, or the Swiss franc, all thrive in these conditions. And in this sort of range, we can see we're clearly above the 20. So the aforementioned investment tools would be supported in this environment, while currencies such as the Australian dollar would be hampered due to their perceived risk. So the risk that's currently, causing all this is mainly the tariffs with, flip-flop between tariffs are on, tariffs are off from Trump, and retaliationary tariffs as well from China, from Canada, etc. And from that, we also have the war in Europe and the Middle East feeding into this. There's been talks of peace agreements, however, nothing has materialized yet. And the longer the talks go on, the more uncertain the market becomes and the higher, the risk is in the market. So you can see that the market hasn't really been as risky in a long time. This would have been towards the end of the year last year, and you can see we're nearly above that previous spike. Moving on to the US dollar in particular, the last couple of weeks we've seen the US dollar decline slowly but surely. This is, due to a variety of factors. One key thing is Trump has expressed his desire for the dollar to be weaker. And so with that, we do expect, these lows could be the next sort of targeted area for the dollar. So we are still relatively quite short on the dollar. Some of the things that are feeding into the bearish dollarness is the growing concern about the US economy, slower growth, rising inflation, and a possible recession. When Trump was questioned on a possible recession, he said that the economy is currently undergoing a transition period, which is pretty much a politician's answer. In terms of the tariffs, like I mentioned earlier, tariffs have been flip-flopped between being on and being off and being delayed. We expect more tariffs to be announced, more tariffs to be delayed, and all round confusion, to be perfectly honest. And lastly, the job sector has declined. Moving on to the Canadian dollar, we also feel the Canadian dollar is very bearish at the moment. As you can see in the last couple of weeks, it's just been falling and falling. We're expecting this trend to continue due to the tariffs. One of the key things to note is the fact that China has recently implemented a 100% agriculture tariff on Canada, and the US have obviously been implementing their own. One thing to note is the employment growth stalled last week, and this is ultimately leading to a weaker Canadian dollar. In terms of the pound, there was very little news last week. One thing, that's a slight misspelling there. One thing to note is the UK banks have been borrowing the most money since the pandemic. That's the COVID pandemic, and there are currently stagflation fears in the market. So we could expect it's a sort of hover around this region where it is, not really going much higher or lower. The governor of the Bank of England recently shifted his rhetoric to be slightly less dovish, and this is due to a variety of reasons. such as the retail sales data. Moving on to the euro has been on a tear the last week. This is due to a variety of reasons. So, one of the main driving factors behind this large run up here is due to the new plans across Europe to increase spending, and this is in the 200 plus billion pound or 200 billion plus euros range. The GDP for the Eurozone also expanded recently, and now traders are pricing in approximately 25 basis point cuts for the rest of the year. A key point to note is the policymakers at the European Central Bank shifted their language and they are now not on a preset course, which essentially means they are not as dovish as they were before last week. In terms of where we think the euro will go next, we honestly think the euro is slightly overextended here. Um, in terms of the German economy, the new election or the elected party are trying to reform a debt brake, which essentially would allow Germany to spend more money. However, right now it's all rumours and nothing has actually been concretely put in place. So we feel that the euro is slightly overextended and we feel a pullback is warranted. Whether from there it keeps going lower or goes higher, we're not too sure, but we do expect it to come in possibly around this old high there at this equilibrium point of this range, but that remains to be seen. In terms of the Swiss franc, the annual inflation ticked down once again from 0.4% to 0.3%. So inflation is just creeping towards that deflation stage very slowly but surely. And the Swiss unemployment rate was calculated at 2.9%, which, relatively speaking, for the Swiss franc in a seasonally adjusted manner, is pretty high. Um, the last sort of week, we can see that the Swiss franc was going higher. This is again due to the tariff risk. It sort of follows the trend of the VIX index, where it's going higher. So really, we could expect it to sort of hover around these highs of this range for a little bit longer until there's some more clarity with the tariffs. In terms of the yen, we expect the yen to just keep pushing up between its economic setting, where things like unemployment rate being relatively low, GDP expanding, retail sales increasing, all these things leading into encouraging rate hikes from the Bank of Japan. Also, with the setting of safe havens and the risk in the market, we're again expecting this to help boost the yen to possibly take out this high, but at least for this upcoming week to just at least keep going higher. We're not expecting a rate hike at the next meeting. However, there's a 46% chance of a hike in June. In terms of China, they last week announced their new GDP target was 5% for the year of 2025. They also introduced their own tariffs against Canada, as I touched on previously. And a key point to note is they lowered their annual inflation target from 3% to 2%. And this is quite a major policy shift, as it has been a long-standing goal of a 3% target. We here at HPD Trading believe this is to help support the Chinese yuan as a stable market environment where investors won't lose too much or be exposed to too much risk with their investments or holdings. And the central bank governor also last week stated that this year interest rates will be cut, which, to be honest, they've been repeating for multiple months now. However, there's no clear timing on the rate cuts. In terms of the Australian dollar, there's about 225 basis points of cuts expected for the rest of the year, and the RBA is slightly more dovish than hawkish. One thing to note is the exports increased to an 11-month high, and the GDP has expanded rather well in the last quarter. You can see the last week it sort of hovered. This is basically due to the positive data in terms of the this sort of stuff, whereas the risk environment is what's brought it back down. And in a similar trend, the New Zealand dollar, as we've stated before on the channel, the bank, the Royal Bank of New Zealand, have said they are openly willing to weaken the economy or have a weak New Zealand dollar, I should say, in order to promote a stronger economy. Between that and the risk in the market right now, we are seeing, it's coming down essentially. One thing to note is last week, the governor for the Royal Bank of New Zealand unexpectedly resigned, and he will essentially be out of his office by March 31st. So that's all we have for today. I hope you've enjoyed the video. I hope you've found something useful and insightful. As always, if you have any questions, comments, or queries, feel free to leave them in the comments below and we'll make sure to get back to you. And with that being said, have a great week and good luck with trading.